everybody for joining us this evening. We're doing a special presentation with some of our own MFM members on a deal that they've closed just recently during the pandemic, which is very impressive, especially nowadays when there's so much change going on over here. So, overview, we'll just do some introductions, some general messaging for the next 5 minutes. After that, we'll just go through a question and answer type presentation, not so much a presentation, but just the deal analysis that Brian and Mandy helped take down. And then afterwards, we'll break off for some joint networking. 3 to 5 people in a group and network for 15 or so to 30 minutes. So I guess to get started over here, Brian, Mandy, did you guys have any announcements that you wanted to discuss?
I just mentioned that for December, we are not going to do this particular meetup in December. Keep checking the website, and the Multifamily Masters group as a whole will do some kind of holiday event, probably mid-December. So after tonight, we will be back the first Tuesday in January, which I believe is the 5th and the 6th.
Mm-hmm.
So that's all I had.
So a little more color around what we're going to be doing as MFM for December. It's December 14th. We will be doing a live stream with a bunch of different experts giving 5-minute snippets on whatever their expertise is. I've had a chance to talk with a couple of the people we've invited, including some ex-pro NHL players who really work with, mindset development stuff and health and fitness, things like that. It's going to be really cool. I've heard some stuff that they're going to do, and it's going to be just 5 minutes of really power-packed ideas. So stay tuned for that.
Yep. And just a general recurring theme in real estate, it's a lot about the people who you work with. The network that you build and grow allows you to get deals done that are much bigger than what you could do on your own, and potentially a lot more valuable. So keep that in mind. Real estate's definitely a team sport, and that's why we're here today. Anything else you guys want to mention, Mandy, Brian, or?
Nope.
Okay,
cool. Excited to dig on this deal.
Awesome. We'll do some quick introductions. So I'll start first. My name is Kevin Dugan. I've been part of Multifamily Masters the last almost 2.5 years now, and it's really grown a lot since we accepted the meetup group back in the end of 18, going to 7,500 plus members. It's really built off of community. Individuals can learn, grow, and educate themselves and empower themselves to invest in real estate. I've been investing since 2012. I own a residential turnkey business in Chicago. Company and provide nice passive residential turnkey investments. I'll pass off to Brian. Go ahead, Brian.
Yeah, hey Kev, just FYI, your audio is not great. I don't know if there's
first world problems.
Okay. Yeah, I'm out here in Hawaii, guys, so
a little better.
Ignore the intro, but if the questions don't come out, definitely let me know. I'll repeat the questions.
Yeah, okay. You've got it.
So I'm Brian Kokendorfer. I'm here based in Chicago. I've been in the multifamily space for about 14 years as a broker for most of that time. I have invested passively in a couple deals and started acquiring actively in the last 1.5 years or so as well. Have a couple properties in the Indiana market as well as a few smaller properties in the Chicago area. And I think one we are going to talk about today is the most recent acquisition down in Indianapolis.
Mandy McAllister, also out of Chicago. I am a medical device sales professional by day and a multifamily investor. I claim to be a mindset ninja and eternal learner, which just means I read too much. But I started out investing in small multis and started a meetup 3-ish years ago, and have been pumped to see what it has become in joining forces with other people like Kevin and Brian, and recently got into larger deals with Brian and team to take down what we think is a pretty awesome asset with a business plan that is not 100% exactly like what we're hearing everybody else doing. So lots of theories and ideas behind that we're happy to talk about today.
Thank you both for the introduction. I'll just get into the quick mission statement over here, then disclaimer. So Multifamily Masters is a grassroots community built to connect, educate, and empower people to build wealth through real estate. And that's why we are all connected today. And just a disclaimer, today we're presenting educational information. It's not legal or financial advice. So if you need to dive deep into the shit, please consult a legal or financial professional for any situation. So with that formality out of the way, can you guys hear me all right?
For the most part.
We'll stop you. We'll talk
Okay.
over you if we can't.
Okay. Perfect. So speaking of teams, I wanted to discuss the project that you guys have, this 53 unit Verdana. Tell us how you guys put together your team, pros, cons, and any advice about that.
Yeah, so this was a very basic joint venture. Actually, our partner Mark is actually on the call, and Mark is somebody that I've known for a few years, probably 5 years now or so, throughout my brokerage career. Talked about a lot of different deals with over the years, and we actually acquired a property in Northwest Indiana up in Chesterton about a year ago. So that was a 100-unit property, and we closed, I think September, October of 2019. So that project's been going pretty well. And when we came across this one, he was really first called to see if he wanted to partner up again. So we just did this as a 3-person joint venture, no syndication, kept it pretty simple, and that's the team.
Mm-hmm. And Brian and I had known each other from the meetup that I started 3+ years ago. So we had talked about deals and, ideas around assumptions for underwriting, things like that. And my brother is a physician in Indianapolis. So we had talked about the Indy market, why I like the Indy market, the kind of capital base that I saw developed through, this group of physicians in Indy. And that's how he knew that I had interest in that market and how we kind of all came together.
And your brother was also he lived in the Speedway area, right where this project is, right? Yeah.
Yep. And I happen to know some syndicators that had a number of properties in the area. So, for purposes of kind of getting the lay of the land, I think that, investing out of state makes a ton of sense, but it's invaluable to have real life opinions on what's happening in that area. So, the chance to have, I lived there, don't turn left on this street or go to that store. That type of information is invaluable in my opinion.
Thank you guys for sharing it. I also want to extend the invitation out to in the group here to ask questions that you have. Just drop them in the chat and we'll make sure to answer.
Shoot. Uh-oh. You're freezing up, Kev.
Yeah.
So maybe we should just
or something.
Let's just kind of freeform if you don't mind. I'm sorry. Yes, Carry the Two. It's a movie, 3 words. Okay. So let's talk a little bit, Kevin, if you want to try to find a better Wi-Fi signal while Brian and I just kind of take over, and then we can ask more questions as we go. Yeah. So, joint venture that I think Kevin was digging into there. We hear a lot in this world of multifamily of syndication, doing these bigger deals as a larger syndication. So, Brian, let's start talking a little bit about why joint ventures seem to work specifically for this deal.
Yeah, I mean, this deal wasn't one that needed a really heavy lift or rehab. And a lot of times when you're syndicating, the investors that you bring in as passive investors, they want to get their money back in 3 to 5 years, or at least a good portion of it. This particular property was more of a cash flow day one play. It was a former assisted living facility that the owners bought in 2018, I believe. They fully renovated it from top to bottom, new roof, electric, plumbing, all new interiors. Everything was brand new. So this was more of a stabilized cash flow day one. I think some investors are now starting to turn towards that model going forward. They just want a safe place to park money for a while. But the last 3 to 5 years, a lot of the syndications have been value add deals where you buy a property, you rehab units, you refinance after 2 or 3 years, and then you get a big chunk of your money back, and then you can recycle it into something else.
Yeah. Let's, I know we have a couple of newbie guys on here, and we're recording this for other newer investors too. So let's, I mean, if you don't mind, I'm gonna define a couple of things here. Syndication basically means it's a very large investment, usually a extra large apartment building that we would basically sell shares of, and there's a bunch of SEC hoops you have to jump through to be able to sell those shares. If you're doing a joint venture, that just means it's a venture that's joint with just a few people, and everyone per the SEC has to be actively involved for that to be allowable. If someone is 100% passive, it has to be a syndication, and you have to follow those SEC rules. And we've talked a couple of times about value add. What does that mean? Well, basically the value of a property is a commercial property is a multiple of what its net operating income is. So if you see something that's underperforming or can have a bunch of cash put into it to increase that net operating income, you'll be able to drastically increase the value of that property. What we're saying here is that property, the veranda asset that we took down, it already had undergone that value add. It was already a stabilized, meaning everything was fixed up and kind of near the top or market rents. So what we did is we put a long-term loan on it so that we could have cash flow for a very long time, which is, you know, not a normal plan, because if you buy into a syndication, if you buy a share, you usually want to realize that value add money within 3 to 5 years. So sorry for backing up, but I think it's important in case newbies are listening. So
Great info.
Kevin, you back?
Can you hear me better now? Maybe.
I think it's better. Let's give it a go.
Not. Okay. Yeah, so it definitely unraveled a lot of information right there. Thank you, Mandy, for sharing that. Let's move on kind of the other area. So you talked about the team, the joint venture. What did you love about the market and your sub-market in particular?
So for me, it's, you know, when I was originally looking for a market to invest in, where do you hear people always need a place to live, but people kind of vote with their feet, right? Like there's people, you know, some are leaving Chicago because of politics, some are leaving Chicago because of taxes, whatever. That's my opinion, but the data supports it. If you look at Indianapolis, there's, you know, growth of jobs, there's growth of GDP, so overall earnings. There's a very diverse group of employers. So it's my opinion that people will continue to want to live there. And specifically the Speedway area, the Indianapolis Speedway was owned by the same family for many, many years, and it kind of deteriorated a little bit. But the Penske family, if you've heard of them, and if you watch Cars, the movie, like I have 742 times with a 4-year-old, you'll know that the Penske family, they started buying a bunch of tracks in the area, and there's this huge bolus of cash investment, capital improvement of that area happening. So we see cranes in the air everywhere. There's a bunch of neat, nice, beautiful new areas, little places that, you know, people will go sit on patios and, you know, eat Mexican food. So I see that being a very developing area, an area that people will continue to want to live for some time to come.
Yeah, and one thing that I'll add to that is, in looking at the area, it seemed like all the key demographic points that we look at were in the positive direction. Population was growing, jobs were growing in that pocket. And one key thing, there was a couple larger complexes that were 300-400 units each within probably half a mile of this property. Those buildings traded about 3 to 4 years before we acquired ours. And the broker was telling us, you know, as soon as those properties traded, the crime in this area went way down. So went back and did a 10-year search history on the crime in this particular pocket, and they were right. Crime was higher. Then all of a sudden it dropped down in 2018. In 2018, 19, and 20 were all at very low levels of crime. So that collectively helps, give us confidence in this particular area.
And I think to that point too, with the new developments, there's this A-class, super beautiful, pristine new construction. This was, a very well rehabbed asset, but it wasn't the very, very best, the very top of the pyramid. So it's kind of nice to have a buffer that you're not the absolute nicest thing on the market. Kev's in his room.
Perfect. Thank you guys for discussing. Yeah, I know. I'm moving around over here. Can you hear me all right?
Yeah.
This is like a Verizon,
Can you hear me now?
Verizon commercial. Yeah. So you guys kind of talked a lot of details on people moving to the submarket. Are there any specifics that you guys look for job growth, population growth, median income, etc.?
Yeah, I'd like to see, if possible, 1.5 to 2% job growth, year over year in the area. Median household income, anything in the, low to mid 40s, I think is kind of a good target for, B and C class properties. You don't want household income where it's too high, where people are more likely to buy houses. You want to keep it where, more renters, or at least a good mix of homeowners and renters. So those are a couple of the main ones I look at. Mandy, how about you?
I totally agree with that. And I think in terms of COVID world, I like that this isn't directly in the city center, because if we are entering into an atmosphere where people get freaked out around sneezes, I don't want to personally own a 90-story city center building. I like that this has some green space and people aren't directly on top of each other, but it's outside of the city enough that they have a little bit of room.
Yep, that's perfect. Thank you guys for sharing some of those specifics. And I agree, there are a lot of people moving from city centers right now, especially as COVID is a major problem throughout the US and the world. Let's switch gears over here to sourcing the deal. So tell me about how you guys found this particular.
So this property was through a broker. It was on the market, and it was actually the same brokerage team that sold Mark and I the property in Chesterton a year ago. So we had already gone through a full transaction cycle with them. We went contract to close on time, didn't retrade, did everything very quickly, very efficiently, and had a good experience with them. They had a good experience with us. So when this property was coming out, they knew that we were looking in the Indianapolis market as well. And so they called and gave me a heads up about a week before it came to market. So I was able to look at some market information. And then once they hit the market, came down a week or two later to tour it and got in the process from there. And there were a couple offers on the table. And I think when it came down to it, from what I understand, there was 2 very close offers. And in part, the sellers went with us because we had recently closed the transaction with that brokerage team. So getting to know the brokers and building that relationship is a huge component of this.
Absolutely. And you've heard likely the law of the first deal. You guys, it's real that once you've closed with a team or in a given market, you are the pretty girl at the dance, and they bring you, you get a chance to see stuff that you likely weren't seeing before you closed. So that was a really big deal.
Yeah, that's huge. Definitely want to emphasize that point where once you get a bigger multifamily under your belt and brokers see that you actually execute, once again, you get fed great investments that make a lot of sense. Brian, any other tips you guys want to share, or Mandy, about build those broker relations to find and get better deals?
Just stay consistent. It's easy to call a broker once, tell them what you're looking for, and then think that you're going to get a call 2 months later when they have a deal. The fact is, brokers talk to a lot of people all the time. I think it's important to just stay in front of them. You want to get on their email list. You want to start underwriting some properties, then also give them feedback when they send you a property. They want to know, what do you think? Do you like it? Do you not like it? If not, why not? Like, what are you looking for that this property doesn't have? So, constant communication and feedback, I think, is key.
And I think networking with other owners in that area is a big deal too, because having some knowledge of the guy who owned the building across the street, he was able to answer a couple questions for us. And then we ended up actually submitting an LOI on something that guy owned. So I suspect if that one ends up falling out of contract, he already has some level of comfort with us that will likely circle back around. So, you know, consistency, always showing up with, you know, not just brokers, but current owners.
We got a question here from Edward. How often should you be following up with these brokers to stay on their radar?
I would say every probably 4 to 6 weeks. If you're just new and you're getting started, you first want to make sure that you get on their email list so you can get access to any properties they come out with. But if you don't get properties from them, then I would follow up at least every few weeks. If you are starting to get some properties, you know, if just underwrite a couple properties, ask for more information. If they send out, you know, an email blast with a new property, follow up, ask for the rent roll and the income and expenses. You can underwrite it. And then, you know, a couple weeks later, follow up again and say, hey, what kind of activity are you getting on it? Just start building some rapport with them.
Mm-hmm.
So I would say at least every few weeks.
I think that's incredible information, you guys, because if you don't know, Brian is a broker by profession. So this is not only what he does, this is what he likes to see and be in receipt of as a broker. So yeah, take note of that.
Yep, 100%. Great tips right there. Once again, I say it all the time, but this is a person business. And if you want to be on somebody's radar, you have to reach out to them so that they know you're still in the game, you're still active, and you're actually responsive, analyzing the deals, giving feedback on what you're looking for. Circling back to another question from Esteban. Esteban mentioned a couple key metrics: GDP, job growth, diverse workforce. What tools and resources do you find useful for finding this market data, and how is that data attained?
It's public information in most cases. City-data.com is a really good one for a lot of those metrics. Gosh, what else?
Spot crime.
Census.gov.
Spot
Yep.
crime.
Spot
Yeah.
crime.
Yep.
There's a lot of resources. We could probably assemble a couple and send them out to everybody,
Yeah.
but it depends on what you're looking for. A lot of it's public knowledge. Some websites use this to consolidate it into a digestible format.
Mhm.
Yeah, the city-data.com, that's a huge one. That's usually the first stop because you can get a lot of information on job growth, population growth, unemployment. A lot of that's right there.
Mhm.
Cool. What tips do you guys have, me jumping back into some of the questions, like for finding great investments in today's environment? And great investments are broad because obviously it's personal in terms of the strategy you're trying to execute, but feel free to take your interpretation.
You know, in my opinion, it all starts with what's your end goal. And the three of us kind of all decided that cash flow is our ultimate goal. And, you know, the cash on cash metric is the one thing that matters most. So, you know, with a lot of eyes on properties, in my opinion, you have to think about what are you willing to give up so that you're looking at something that not everybody else is looking at. In my opinion, I need to see the basic metrics of jobs and GDP because I need that strong workforce. I need to know people are going to be demanding where I own. And, you know, maybe we give up a little on the size of the property and achieve scale in some other way. So the fact that this was a smaller than, call it 100, 150, 200 unit property meant that, in my opinion, there were fewer eyes on it. And the fact that it was stabilized as well, because I think a lot of people are looking for value add opportunity so they can achieve that fast pop of income growth. So that's how I think that, you know, we were looking at stuff that not everybody was looking for, in my opinion.
Yeah, I think having clearly defined criteria of what it is you're looking for, you know, what you might think is great might be different than what I think is great. So just first identifying what it is you're looking for, then trying to focus on finding properties that fit into your criteria. That's one way to keep focused on your primary goals.
Awesome. Thanks for offering some of those tips and advice. Uh, Switching gears slightly over here as well, real estate analysis. So understanding the fundamental numbers behind the project, determine whether or not it's a great deal or not. What did you guys do to, I guess, how did you underwrite this project? And to follow up, what type of stress analysis did you do for it?
Yeah, we thought up some stuff that I think was pretty clever that I'm excited to share here. In underwriting anything, the kind of mindset that I take on is, first I want to understand a worst case scenario. And then second, I want to understand where I think things are going. Like that's the Goldilocks. And then I want to kind of understand what is best case scenario and shoot for that. So you manage towards the best case scenario, you kind of shop it on your Goldilocks. And then in getting comfortable with that worst case scenario, Brian and I spent a lot of time digging into what's our break-even point. And we found it was a 42% economic vacancy that we could have and still be able to pay all of our bills. So that gave me a high level of comfort. And then with this COVID stuff that was going on, kind of listening to a lot of economists, I noticed that the people who were losing work were the ones who had kind of more blue collar, no college education jobs. The people who were nurses or police officers or computer programmers or whatever, they were keeping their jobs and they were able to work from home, but manicurists and bartenders and whatever, they were losing their jobs. So an interesting thing that we did is we asked the previous property manager to give us all of the applications for current residents. And from that, we were able to figure out what their job was. And I kind of went through one by one and I said, okay, that's a questionable job. This is a really good job. This is a questionable job, and so on and so forth. And, we only showed that maybe 20% of them or so had a job that we had a concern about, which was, far above the 42% economic vacancy concern. So that's what gave me a high level of comfort to move forward in this.
Yeah, and that was something that Mark was focused on as well. What do these people do for a living? Is there any way to figure out if they're still employed? So we definitely made sure to get all the job or all the rental applications. We can figure out, for the most part, where people work. But one thing that was interesting is that we went under contract here. I believe it was late, or maybe LOI late May, and then June we kind of negotiated the contract. So if people remember, March, April, and May were the first 3 months of COVID. Nobody was really sure what was going to happen with rents at that time. Well, it turns out those 3 months were okay. Then June, July, and August came, and then all of a sudden there was a shift with a lot of landlords where the rent income started adjusting down a little bit during those months. So it was interesting. I believe the first month that we had new financials for after we went under contract was June. And the income dropped 8 or 9% from June, July compared to March, April, May. So it came back up in August. And so we had to adjust for that in the underwriting as well, make sure we were still comfortable with the downside, really try to get a handle on, okay, why aren't these people paying? Did they lose a job? Is it a one-time thing? Really try to dig in deep there. Thankfully, by August, it came back up enough. And our collections in September and October were 100%. So it ended up being a blip and not a, new path forward, but it was something that was concerning as well, given the timing.
Perfect. Any other items that you guys want to discuss on some of your underwriting? I mean, obviously focusing on the jobs and your resident base, paying the rents is really important.
I'll say, especially regarding
an extra step that a lot of people can take to the who's there.
Especially regarding this deal and where we're at in COVID. One thing I really like that we've agreed upon doing, it's instead of like a buy and hold or a 3 or 5 year business plan, we're kind of, we bought and now we're going to watch. We've got a bunch of different potential exit strategies, and we're going to be able to recalibrate as we go on, because we got a loan that was assumable at a really great rate, but it's for 15 years. So we have a lot of options that we're not really locked in on any one exit strategy, which I think gives me comfort around this too.
Yeah, and I would say 2 specific things on the underwriting. One is, a lot of people just automatically factor in 3% increases for rents every year. And given that this was during COVID, we put in 0% for the first year, 1.5% for year 2, and then 2.5% going forward. So we were ultra conservative on rent growth. And a lot of people, especially newer syndicators, they want to make the numbers look good to their investors. They just plug in 3% automatically no matter what. The second thing is, because we got a Fannie Mae loan, we had to put up 12 months of principal and interest up front. It's really hard to underwrite for that. It's an extra cost that just goes into a separate account that we can't access. So once we get that money back in 9 to 12 months, which is how long they hold it for, we essentially are just going to leave a good chunk of that into our operating account as kind of our rainy day / CapEx fund. So because we didn't have any particular CapEx projects in year 1, well, we had one that we had to account for in due diligence. But outside of that, anything year 2 and after, we already have covered. That's how we're raising that money, is using the principal and interest reserve that we had to use for Fannie Mae.
Cool. Thank you for sharing. Underwriting's an incredibly important part of multifamily investments. A lot can be changed by changing a particular cell line, and it'll drastically change the numbers.
You can change the spreadsheet, it ain't gonna change the deal.
Exactly. So taking the time to tune in and sharpen those numbers is really critical. So I think I'm choppy over here. You guys have any other things you want to mention, Brian, Mandy?
We can take a couple of questions that are in here real quick. So Edward asked, for the 12-month principal and interest requirement on the Fannie Mae loan, is that a new requirement because of COVID, or has that always been the case?
It was COVID related. It's always a moving target right now. I don't even know where we're at right now, but when we're underwriting new properties in real time, we consult our loan guy and we figure out what is required at that point. So this was COVID related, and it is a moving target. So make sure you're checking for what reserves or requirements are given any point in time that you're looking at a deal.
Cool.
And
all right.
Real quick, you said, what were your individual roles in the joint venture? So with joint ventures, you don't necessarily need to have individual roles the way you do as a general partnership, as part of a syndication. When you're a general partner in the syndication, usually there's more clearly defined roles. There's kind of an underwriter, an asset manager, a capital raiser. You don't need those clearly defined roles in a JV as much. You can just have 3 groups of people all throw in, some money into a bucket of cash and split it up that way. In this particular case, we all did a little bit of everything. I did a lot of the underwriting on the front end. Mandy did a lot of the, like going through the rental applications and due diligence stuff during that time. Mark was very involved when we were going through the due diligence stuff and the upfront loan process as well. So we kind of split it up, but you don't necessarily have to have clearly defined roles in a joint venture the way you would a syndication.
Yeah, joint ventures offer a lot more flexibility since everybody's name is on the loan. So great structure, definitely recommended with the right type of partnership. Okay, so I wanted to chat a little bit more about the due diligence process. You mentioned some of the leasing. Tell us a little bit about the actual on-site inspections that you guys did.
We walked every single unit. And there were some areas that originally they weren't going to take us down in the basement. And lucky that they did. It had rained pretty heavily the day before, the day of, I forget. But regardless, there was some water that we found in that basement that was completely unused, which ended up yielding a little bit of negotiation power, I guess. But it was like the one day that it could have rained because we're not really seeing that moving forward. But in terms of walking the property, there was a whole team of people. There was Brian chime in here if you don't mind. It was us and from the survey group.
Yeah, so we had a third-party company come out and do they walked about 30 to 40% of the units with us. The appraiser was out there that day. We had somebody specifically looking at the, the structure, the roof, mechanicals, basement issue. So that was, it's kind of a little party. We got through it in probably 3 hours. One thing that was interesting is the property manager is, usually following you around pretty closely. And the last thing they want is for you to be talking to tenants. And I can tell you that as a broker, the last thing that I want is for the buyer to be talking to tenants, because it can be a great building, but there's always disgruntled tenants. And Mandy, being the chatty Cathy that she is making friends with every tenant she can. But the property manager was kind of trying to talk to her with her. So when the units that I was in, the same one as her, I would try to talk to the property manager, distract him a little bit. She would kind of mosey into the other room and start talking to the tenants. And so you can get some good information, like how do you like living here? Any problems? And so, we were able to tell, like, oh, my dishwasher keeps going out. So, just
washer and dryers are a thing. Yeah.
Yeah. So it was pretty fun.
Yeah, I especially wanted to ask this question because it is more of a stabilized asset, and negotiations on a stabilized asset should be a little bit stronger, especially after all the walkthroughs.
Yep.
Awesome. And were there any items that were able to get you some strong negotiations through the inspections?
Yeah, so go ahead.
Well, we didn't go in wanting to retrade, but the reports that we got back on the fix for the basement was more than we anticipated. So there's a long story around that too, of making sure that whatever structural engineer is going to give you an opinion on that, we want them to see with their own eyes, because they were telling us just fill it with cement. I mean, you guys, if you saw how huge this basement is, like, it sounds like something they would do like out of the mafia in New York, like just fill it with cement. But had this guy seen it with his own eyes, he would have understood that it's not, a small basement. That's not a feasible fix. So, right.
Yeah, and it was an actual structural issue. It wasn't like, oh, there's a little water coming in the basement. Buildings that, were built anytime before, 2000 get some water in basements. Not that big of a deal, but this was an actual structural issue with the foundation that we have to go back and reinforce in the spring when we can. So to Manny's point earlier, had it not rained as bad as it did the night before, we might not have noticed the water in there, which triggered us to have a structural engineer come out and look at it, which then triggered, okay, hey, this is actually a problem. So we did have to go back and negotiate a credit for that work that we're going to have to do in the spring.
And it's safer now for tenants
Brian,
and there's potential users.
So retrading is something that's usually a big no-no, but here it seemed to make sense. What's your take on that?
Yeah, I mean, look, there's people that no matter what price they go under contract with, they're not going to close at that price, because it's always just a game to them. They just want to see, how much can I get off the price? If I go in and I'm under contract at $5 million, I'm going to tie it up for 30, 45 days through the due diligence financing, come back the very last day and say, okay, I need it for 4.5. And then maybe they settle at 4.8 or 4.9. They just always need to get a little bit more. But those people aren't looked at as preferred buyers for the most part either, because brokers don't trust them. Obviously, if you have to come back for a price credit, if it's a legit issue, and by that, I mean, if it's something that was unforeseen when you first underwrote the property, then there's usually no, black mark against you as a buyer. Anything structural, foundational, if there's an issue in financials where what they provided up front is different than what they provided when you dug into it, then, those are legit concerns that have to be addressed. That's a problem for any buyer, not just a problem for this particular buyer. So I always try to differentiate that both as a buyer and a broker, because there are some people who just play that game where literally no matter what they go under contract with, they will never close at that price.
Thanks for sharing some of that brokerage.
Could oh, am I mute? No.
Yeah, no,
Go ahead, Mark.
I was going to say that was I thought, a very wise strategy that Brian and Mandy, the way with this one issue, Brian was really trying to avoid retrading the price and the asset, knowing this team brought us this asset and that they probably down the road, Brian's already thinking of possibly the next deal. And how do you maintain that sort of priority in their list of calls? It seemed like that you're a good buyer, that you're not going to do it unless it's a real issue that is truly affecting the economics, and it wasn't something you wanted to do going into it. So I credit you for that. I think that was a smart way to handle it, and it's a smart strategy.
Yeah, you just got to be, you got to pick and choose your battles. And again, that was a very legit issue. So, you know, even neither the brokers nor the sellers really, you know, had any issue with what we were asking for because they felt it was legit as well.
and it kind of happened simultaneously with that blip in June collections.
Yeah.
So we had a great case that, you know, we might not be able to get the loan proceeds that we'd anticipated that made this pencil out the way that it did if we don't have like a T3 that reflects collections that are going to equal what we need. So there was a couple of different things at play, but the structural pieces ended up being why we ended up with credit.
Awesome. Thanks for sharing, guys. A couple questions from the chat over here. So the previous property management style, how will you guys manage them now? Third party, local, or self-managed?
So we have third-party management, and it's actually with a group that is based out of Chicago, but they also own and manage about 3,000 units in Indianapolis as well. I've known the principals of the company for the last 10, 12 years or so throughout my brokerage career. So we use them, and they also manage our Northwest Indiana property as well. So they have third-party management, local, fully staffed. They also have a construction team down there. So if we need rehab on any units, they can do that work as well.
It's really nice that they have their own assets in the area that are of a different class. I'd call us a B plus, and I'd call them a C minus. So they know the area really well, but it's not a real competition in terms of tenants. So that's really nice. And one thing that we're doing right now is we're making sure to get down there and have live conversations and inspections of the property at least monthly, usually bi-weekly, in this kind of short takeoff period. So third party, but check, trust, but verify.
Okay. We're already at 6:47. I'm sorry, trying to do some math over here. 7:47. Do you guys want to discuss any of the loan or any of the business exit strategy?
Sure. We kind of touched on it super briefly, but it's a Fannie Mae product that we ended up putting on this. And it's originally when we got the quotes from our broker, it went up to, was it 12 years? And we basically said, hey, man, it would be nice to know how long of a loan term could we get on this? And he went back and produced a 15-year term with 8 years of interest only, which totally complied with the let's get as much cash flow out of this in place stabilized asset as possible. So, you know, notes on the loan, Bri?
Yeah, I mean, as far as, like Mandy said, it's an 8-year interest only loan, 15-year fixed rate. We're under 3.7 on a fixed rate, which we were all super excited about. One thing that's interesting, because like she said, all of our goals were really cash flow. We just want to build up cash flow and maintain it for long term, but you never know what's going to happen. And with this particular loan, as long as there's 7 years left on the loan, somebody can come in and put a supplemental on it. So if we decide to sell anytime in the next 8 years, somebody can come in, assume our current loan, and take out a supplemental loan to bring the loan to value up to whatever it needs to be for it to make sense. So that was one thing. It gave us some flexibility within the first 8 years on if something changed with our strategy and we wanted to sell. Although at this point, our initial plan is to keep long term.
Awesome. 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 Thanks for sharing that. And last thing over here, exit strategies. I know you guys have a couple different options, but you mind breezing through that really quickly?
Yeah, well, with the low rate under the 3.7 and the ability for another team to assume it, like Brian just described, that will, you know, if we see interest rates tick up considerably, call it, you know, let's say if we're at 5% in 6 years' time, a 3.7%, 3.68% rate will look amazing, and we'll potentially be able to attract really great buyers at maybe a higher price because we have that loan. So that's one thing we'll be able to watch for. If not, we have that 15-year term, which will yield the ability to ride out an entire business cycle and longer potentially. So the buy and watch strategy is kind of how I've been explaining it.
Yeah, I agree. I just saw, so Michael asked about debt coverage ratio and loan to value. Loan to value was 75%. The debt coverage, I believe, was about 1.35 to 1.38, if I'm not mistaken, for the first year. So it has to test out at 1.3 for us to get our principal and interest reserve back. And this was between 1.35 and 1.4.
Any other questions from anybody else in the group?
Looks like Harry asked, what would happen if with the JV, if the other party screwed up their personal life, if in an unforeseen instance, can that person drag down the overall JV? If yes, what is a good structure to protect the JV?
This is kind of like the hit by a bus clause.
Yeah, I think so. So I would just start off by saying, talk to your attorney. Obviously, we have an operating agreement that our primary attorney drafted and all of our personal attorneys kind of checked out. I mean, if something happens to Mandy or Mark, it doesn't really change the structure of the deal. Like, you know, even if they screw up their personal life, they can't just come back and take over the deal. So the other partners are protected. There are those protections in the legal agreements, in the operating agreement. Do you have anything else to add to that?
I mean, we did write it in that, no, I mean, not really. I mean, there's nothing really that will, I mean,
there's clauses in the operating agreement that protect all parties. So I don't know if it's a specific clause or a specific line, but you know, if something happened to me, it doesn't mean that it screws up the joint venture and the property for everybody else. It just, you know, my estate has to figure out what happens to my estate.
We did write in terms of decision making. This is what I was thinking. So I'm hit by a bus. My 4-year-old will not have decision making ability for my portion of the deal.
Okay.
Yeah, and also any majority of the group could, I think, change the decision making, like take it away from somebody else, like if there's a vote. So if 2/3 of us, you know, we don't like Mandy anymore, we can't kick her out of the property, but, you know, we can exit her from the decision making process.
Got it. Do you guys set up an LLC for that?
Yes.
Yeah.
Got it. So each of you has an LLC that joins the JV?
Mm-hmm.
Correct.
Yep. And the JV itself is its own LLC.
Got it. So 3 LLCs involved, basically.
Yes.
Got you. Is it wise to not set up an LLC?
I think you're a lot more protected if you do.
Mm-hmm.
You know, an LLC essentially takes away any personal liability. So almost everybody sets up LLCs for this kind of stuff.
Okay, got it. So so just keep it simple. 2 people involved. So each person set up an LLC and then set up another LLC to purchase the property, basically.
That's what this structure is. But I'll tell you, like, even back to my single family and small multis, I own those within LLCs for protection.
Got it.
Yeah.
Do you
talk to your lawyer, not a lawyer.
Yeah. Just try to get the still borrow your experience basically. So let's say you have five properties. They are separate properties, right? Do you guys recommend to set up 5 LLC for each?
Well, here's how I do that, because I own a bunch of smaller stuff.
Mm-hmm,
The decision that I made is I only want X number of dollars in any given LLC, right? So I own a $400,000 condo that is in its own LLC. I own a bunch of like $100,000 single family homes on the south side. I'll put up to like $500,000 worth of equity in each one. So I've made a dollar volume opinion, because if you think of what that is, if you lose an LLC, you're willing to risk everything that's under that umbrella.
Yeah. Do you guys also purchase an umbrella policy to cover everything else, just in case one fail?
Yeah, I do.
Oh, you don't?
I do.
Oh, you do? Okay, got it. Okay, cool. All right, thanks, guys.
No problem.
Yeah, Harry, a lot of these items definitely talk to a legal professional.
Yeah.
Everybody's
Sure.
circumstances are different.
Yeah, I mean, yeah, definitely. Yeah, I just want to hear from the horse mouth, right?
I'm Chatty Cathy.
You know, Brian and Mandy, am I on? I was thinking, Brian and Mandy, that perhaps too, if like Vanya brought up, if like a capital improvement was needed and you needed to put money in, like there's verbiage obviously in the LLC agreement, the operating agreement, that speaks to how that works.
Mm-hmm.
But that, in what I like personally, I own other types of commercial property. Usually apartment multifamily is less volatile, less unpredictable, or more predictable in regards to that. But also, Brian, I believe this, we have these reserves, and we set up reserves for things. So hopefully there's not that much unforeseen capital call type of an event. But if it did happen, I believe if somebody couldn't make it, say because they had an unforeseen event in their life that they for some reason couldn't contribute it, you do want to create an incentive for the other partners to make that up, whether it's a certain interest rate that they earn, something for keeping the project going smoothly. And that's all. I just wanted to say that. And I don't know if you have comment on that.
Yeah, that's a good point. As far as the question with the JV, if somebody, can drag it down, if there's a capital call type event and one person isn't in position to contribute, then it doesn't mean that we can't do it and the property goes downhill or that project can't be completed. It's the other members can fulfill it and then charge back that amount either in equity later or some kind of interest-bearing loan.
Very important to have that in place.
A lot of flexibility.
But also very important to make sure you plan for that rainy day so you never get there.
Hey, Brian, Mandy, can you guys hear me?
Hey, Rahul.
Hi. So can you kind of walk us through as far as your acquisition process, especially when you close the building, that first month, walk us through what, a deal of this size or even close to 100 units. Obviously I have a certain way of doing my, the way I do things, but I like to kind of learn, what else that you guys kind of put in place as you took over this property.
So, I mean, wheels were put in motion between our third-party property management and their property management before things were totally closed up. So it started before the actual close. And there were potential red flags and speed bumps that we had identified. Specifically, we saw of the 53 units, there were 10 renewals that would need to happen in October. So even from underwriting timeframe, we knew that there was going to be work to be done for these October renewals, and had that on our radar and our property management's radar from the very beginning. In terms of the handoff, we did a number of phone calls. We still are doing bi-weekly phone calls to make sure that the processes are working and we have the right information to make decisions. Brian, what's your take on it?
Yeah, also as far as just like kind of going through the initial process, Rahul, you know, especially with properties that are, you know, over say 12 units, you're going to want to have kind of your team in place as far as lender, inspector, insurance. You want all of that lined up and ready to go the day you sign the contract. You don't want to wait until you sign a contract and then start looking at, oh, hey, who can I call around to try to inspect this property the next couple of weeks? You want to have all that stuff lined up while you're making your first offer and going through the letter of intent or negotiation period, where literally day one, like we signed our loan application the day that we signed the contract because we had everything teed up with the lender. And that's a mistake that a lot of people make, which causes for extensions, which causes for problems and deals down the line. So that's, I think, a key point. Anything I would say over 12 units, make sure to have that stuff lined up on the front end.
One kind of logistical thing that I'll say, if this is one of your first larger properties, having all of your documents in a Dropbox or a Google Drive, so that you can easily access an up-to-date personal financial statement to be able to send it on. Brian and Mark had already worked with this lender, and I was able to easily turn around a number of documents because I had them all digitized and easily accessible in Dropbox. So if you're looking to be taking down larger assets, I would say that getting that house in order is important.
Yeah, and then what kind of health checks are you doing with the third party property management? So see, I was more asking acquisition after the handoff.
Oh, we started off with a call every week with the property manager. We have a conference call lined up, and we're down to I think every other week at this point.
Yep.
And at some point we'll get to once a month. So usually when we first take over, we do weekly check-in calls, like, all right, guys, what's going on? What kind of work orders do you have? Any issues with tenants? Then just once the first, you know, handoff is kind of taken care of the first month, we switch it to every other week. And so, yeah, we're in touch with them at this point every other week. And we go down there, like Mandy said before, at least once a month, sometimes twice, to see the property on site, meet with the staff, just, you know, check in face to face as well.
Thanks.
Two last questions came in. Mandy, what date of the month do you prefer to close?
When the deal makes sense.
Yeah, I would say the only date I prefer not to close is like right at like the first, because a lot of people will, you know, have already sent their checks into the owners, but it doesn't get collected.
Right. Good point.
Or then you're having them, you know, sign over checks back. I kind of like the middle of the month because, or the 10th or so, most of the rent is already collected and there's not much, you know, transition. So that's just, you know, a preference, but you can close anytime.
What is the communication cadence or frequency with the general contractors on a value add property? Does this property manager handle all of that? Well, Bri?
Yeah, we're not doing that on this property. We don't have, we're not doing a value add strategy. On the one in Chesterton, we are. And the principals, like us, we are in touch with the main contractor. So the property manager is involved, but we are in touch with them as much as needed. At first, it was, you know, multiple times a week. Now it's, you know, a few times a month, depending on the projects going on. But at first, all the time, like multiple times a week.
Mm-hmm. Looks like all of the questions.
Oh, yep. Harry asked, how did you get your loan written? Is it serviced with that LLC? I assume banks would not loan on an LLC that was barely set up.
Well, we made an entity for the property. So it's a pretty common thing to make an entity and name it after the property. I think you guys did that for your Chesterton deal too. So yeah, they underwrite us as borrowers and our experience more so than the length of existence of the LLC.
Yeah, Harry, they're going to underwrite the principal borrowers and not the LLC. Most transactions have a new LLC set up for that property.
Gotcha. Okay. Do you guys have to personally guarantee the loan by any chance?
Not
No.
Fannie Mae. There's only what's considered they're called bad boy carve-outs, which
Mm.
is essentially if we do anything fraudulent or illegal,
Mhm.
we are personally liable for those. But otherwise, Fannie Mae is non-recourse. If you get a bridge loan, you generally have to guarantee the bridge loan for however long you have that loan.
Gotcha.
So
Gotcha.
you'll likely hear investors talk about agency debt. What they mean by that is Fannie Mae or Freddie Mac backed loans because they're backed by a governmental agency.
Got it. Man, I have to read up on this all of these loans lingos.
Well, you are in the right place, my friend. Paul asks, did you have any tenant issues when you bought the property such that you had to replace tenants at acquisition? We've had some problem payers, and it's super interesting and fun to catch up with our awesome property manager about the hilarious stories from a couple of these habitually late paying tenants. But there was nothing in terms of we needed to lose a bunch of tenants in the turn.
Yeah, our only big concern, I think Mandy mentioned it earlier, was that we closed on September 10th. On October 31st, we had 17 of the 53 that their leases were expiring. So we were very concerned that we might lose 10, 12 tenants at the end of October. Almost all of them re-signed. The couple that didn't, they had leased out before the other tenant moved out. So we had no vacancy issues there. So that was our biggest concern going into it, but it ended up being a non-issue, thankfully. Okay, I think we're
Awesome.
about wrapping up. Do some breakout.
Love it. Thank you, guys.
Yeah, thank you guys all very much. So should we?
A nuisance raise.
Good job, Brian, Mandy.
Did you do a nuisance?
Yeah, Michael, we were doing like 2%, 2% raises on leases, even though we budgeted for 0. We did do 2% because we tried it with a couple. People were absorbing it, so we just kept going. So we did 2% on most of the releases.
We did make a plan, though, that if they push back, that we valued having a tenant rather than the 2% raise.
Mhm.
So that was the communication to our property manager.
All right, guys, I'm going to put us into a couple breakout rooms, and let's, maybe do that for 10 minutes. Maybe we'll do 2 of them tonight. So hold on 1 second here. And off we go.